Forex management latest news. Amid rising external sector pressures triggered by the ongoing West Asia conflict, weakening Forex reserves, and sustained foreign portfolio outflows, the GOI and the RBI are considering a series of measures to attract foreign capital inflows. One of the key proposals under discussion is reducing or even eliminating the withholding tax on interest earned by foreign investors on Indian government bonds. The debate reflects India's broader challenge of balancing exchange rate stability, foreign exchange, Forex, reserve conservation, inflation management, and investor confidence in a volatile global environment marked by high U.S. interest rates and geopolitical uncertainty. Why is India concerned? Pressure on India's external sector. India is currently facing multiple external vulnerabilities. Declining Forex reserves. Persistent foreign portfolio investor, FPI, outflows. Rising crude oil prices due to the West Asia conflict. Weakening rupee against the US dollar. High global interest rates, especially in the United States. The RBI's Forex reserves reportedly depleted by nearly $38 billion in 2 months, intensifying concerns over the sustainability of India's external account. Key objective: the government aims to conserve Forex reserves, stabilize the capital account, prevent excessive rupee depreciation, and improve India's attractiveness for global investors. Proposal under discussion: cutting withholding tax on government bonds. What is withholding tax? Withholding tax refers to the tax deducted at source on interest income earned by foreign investors from Indian government bonds. Currently, foreign investors pay around 20% withholding tax. Earlier, a concessional 5% rate existed until 2023. India's rate is considered among the highest globally. For example, in China it is 10%, temporary exemptions in place since 2018, Vietnam, 5%, while Malaysia exempts government bonds from this levy. Additional complexities in India. Investors from countries with which India has double taxation avoidance agreements, DTAAs, pay lower rates. Investors without Indian tax residency certificates face higher burdens. Taxes imposed on gross income. Losses cannot be adjusted against gains. This reduces the attractiveness of Indian debt markets. Objective behind reducing it: to attract FPI. Lower taxation could improve post-tax returns for foreign investors, increase demand for Indian government securities, bring in dollar inflows, strengthen the rupee, and reduce pressure on Forex reserves. Senior policymakers believe easing tax-related friction may improve India's competitiveness vis-a-vis other emerging markets. Why policymakers are divided. Concerns over effectiveness. A section of policymakers doubts whether tax cuts alone can attract significant inflows under current global conditions. Major concerns. High U.S. interest rates. U.S. Treasury yields remain elevated, making American assets more attractive and reducing risk appetite for emerging markets. Geopolitical uncertainty. The ongoing West Asia conflict has increased global risk aversion and oil price volatility. Limited immediate impact. Officials fear that foreign inflows may not rise meaningfully even after tax cuts, and India may appear economically vulnerable if the policy fails. Forex conservation measures already initiated. Import duty hike on gold. The government has increased import duties on gold, precious metals. As India imports large quantities of gold, it increases the current account deficit, CAD, and drains Forex reserves. PM's appeal: reduce gold purchases, avoid extravagant foreign travel, use public transport and carpooling, minimize fuel consumption, etc. These measures reflect a broader strategy of economic austerity and Forex conservation. Debate on fuel prices and austerity. Officials believe India has delayed fuel price adjustments and austerity measures compared to other Asia-Pacific economies, happened in the region 2 months ago. As rating agencies and investors closely monitor fiscal discipline, suppressing fuel prices may worsen fiscal pressures and undermine India's macroeconomic credibility. Thus, controlled fuel price increases are seen as increasingly inevitable. RBI's Forex intervention strategy. Massive intervention in currency markets. The RBI has actively intervened in Forex markets to stabilize the rupee. Gross Forex sales by RBI, $100 billion each in 2020 to 21 and 2021 to 22, $213 billion in 2022 to 23, $153 billion in 2023 to 24, $399 billion, record high, in 2024 to 25, and $166 billion in 2025 to 26, first 11 months. Additionally, RBI held a net short forward position of $104 billion by February end. Rupee depreciation and capital flight. Rupee weakened by nearly 11% against the US dollar over the last year. Since the onset of the West Asia War, it has fallen another 5%, reaching a new low of 95.96 rupees against a US dollar on May 14, 2026. Foreign portfolio investors withdrew nearly $22.5 billion from Indian financial markets in 2026 so far. This has amplified pressure on equity markets, bond markets, and exchange rate stability. Lessons from the 2013 taper tantrum. Background. When the rupee sharply depreciated due to the U.S. Federal Reserve's taper tantrums, RBI had opened a FCNR-B, foreign currency non-resident, bank, deposit swap window for a period of just under 3 months. During this window, banks raised $26 billion, helping boost the central bank's Forex reserves. Proposal for special deposit schemes rejected. Officials considered introducing a special foreign deposit mobilization scheme similar to the RBI's 2013 FCNR-B swap window. However, policymakers have currently rejected a similar scheme due to changing global conditions and associated risks. Positive developments. Recovery in FDI. Despite capital market volatility, FDI flows showed improvement. Key trends. February 2026 witnessed net FDI inflows of $4.6 billion, highest level in nearly 4 years, and following the interim India-US trade agreement. Overall FDI position, net FDI inflows during the first 11 months of 2025 to 26 reached $6.27 billion, compared to only $959 million in 2024 to 25. This suggests long-term investor confidence in India's structural growth story remains intact. Conclusion. India's current economic situation highlights the delicate balance between protecting macroeconomic stability and sustaining growth amid an uncertain global environment. While tax reforms may help reduce investment barriers, they alone cannot offset global risk aversion and geopolitical uncertainty. A combination of prudent fiscal management, calibrated monetary intervention, structural reforms, and external sector resilience will be essential for India to navigate the present turbulence while preserving long-term investor confidence.